Hey, what's going on, everybody? We got a big crowd tonight. I'm excited to be here. Thank y'all for hopping on tonight. We got a lot of cool things to go over. Um, let's see, we'll get rolling here in a moment. It is, let's see, it's almost 6 o'clock. So the day is moving along. I hope y'all are having an awesome day so far. We got some pretty cool things to jump into. Once again, my name is Reid Mathews. I'm with Berry Financial Group. My father-in-law is Richard Berry. Him and my mother-in-law, Jan, started the business 30-something years ago. I was drafted by the Pittsburgh Pirates right out of high school in the 35th round to the Major League Baseball draft. I chose not to go. I chose to go to college instead to try to get drafted higher up. I did not get drafted higher up, but I did get a scholarship to Coastal Carolina. I had my first wrist surgery before I ever arrived on campus. 3 wrist surgeries later, I was forced to hang up the cleats, and my baseball career was over. And I was like, "Oh my gosh, I got to get a job." I knew when I had to step out and get another career, I knew I wanted to do something with money. I absolutely knew it. I pictured myself being on Wall Street, trading the stock markets, the big glamorous life. And then so I found Berry Financial Group. Well, right after I found Berry Financial Group, I married the love of my life, Jana Berry, who's Richard's daughter. And then I began working with retirees and dealing with Medicare. That was a shock, being 22 years old, coming out of college and learning a ton of stuff about Medicare, which I happen to love now, by the way. And then really diving into long-term care. I did not picture myself doing and talking about long-term care, but what an important topic. And to some people, it's not the most fun topic by any means. So my goal tonight is to add as much value as I possibly can regarding long-term care, regarding planning. What happens if you need some form of care? We're going to dive into a lot of statistics, a lot of different plans, the pros and cons if you do the planning, and a lot of those things. It could very easily be the most important decision you ever make learning about long-term care. So I just feel like it's a blessing that the Lord placed me where I'm at with Berry Financial Group, and to help people make some serious decisions. Because y'all jumping on there tonight, we got a big crowd tonight. This literally could be the most important 30 minutes of y'all's lives, depending on the situation. Hopefully you never need long-term care. Hopefully, Lord willing, I never need long-term care. But that doesn't always happen. So let's jump in, because long-term care, we're going to talk about protecting your retirement nest egg against healthcare risks. Let's look at this picture for a second. You didn't save anything for retirement, did you? That's what this lady is saying to her husband. She's looking under the sheets, and this is a little bit humorous, right? She doesn't look too happy, but when you really think about it, what is this picture really saying? This lady is looking at her husband, who clearly needs some form of care, and her first thought is, you didn't save anything for retirement, did you? Because guess what? Now she's going to have to do. She's going to have to care for this guy or herself. Does it look like this lady can care for him? They both look pretty elderly. Would you agree with that? Most people don't receive care until their low 80s to mid 80s. That's when the majority of people receive care. Most long-term care also is chronic care. That means it happens over time. 80% of care is chronic care, meaning you become frail over time. Maybe one day you're walking okay, the next day you're not walking as well. Only 20% of care is acute care. That means, oh my gosh, I have a stroke, I need care immediately. Oh my gosh, I fell and broke my hip, I need care immediately. less than 20% of people need care with acute care. So this lady's looking at this guy saying, oh my gosh, you didn't save anything for retirement, did you? Because at the end of the day, money is what pays for care. Unless you're going to pay for care yourself, you better have the monies allocated to help someone or to pay for somebody to come in and care for you. The three biggest risks that pre-retirees and retirees face. The first is the stock market risk. As of August 7th or August 8th, 2019, the market's really close to hitting all-time highs. And the number one risk is stock market risk, because if the market goes down and you lose money, then all your plans are really going to have to change, because every dollar that you lose could have been a dollar to pay for care. What's the second risk? Longevity risk. This is a risk multiplier. The longevity risk is an absolute risk multiplier. And what that really means is that the longer you live, the more risks you actually face. I'll just use me. If I die tomorrow, Lord willing, I won't, but if I die tomorrow, I never have to worry about long-term care. I never have to worry about the stock market going down. I never have to worry about becoming frail. But if I live another 60 years, or if you're in your 60s or 70s, if you live another 20 plus years, do you think the stock market is going to go down over the next 20 years? Of course it will at some point. Do you think you could become frail over the next 20 years? Or maybe have a stroke, heart attack, cancer, insulin diabetes, some serious things, and then healthcare risk. That's one of the biggest risks that we're all facing, myself included. Y'all know healthcare costs are crazy nowadays, and we're going to dive into some of that too. What does long-term care mean to you? When I ask that question, 90-something% of people say it means a nursing home. That's what 90-something percent of people say, is long-term care typically means a nursing home. Do you think you could become frail? This is a very simple question. I'm assuming for everybody watching this that they do think there's a chance they could become frail. And guess what? I know for a fact that if I live long enough, my body will become frail. It's just the way the good Lord made it. What scares you most about long-term care? I'm asking some real deep questions tonight, because this is a deep issue. This is a very critical issue that needs to be addressed with people if it's something that you really are concerned about. What scares me most about it is ruining the people's lives around me, my wife's life, maybe my parents' life if I need it. If I have children one day, maybe their lives, the friends' lives. That scares me most about it, because as of now, I can care for those people. I can provide for myself. I can provide for other people and really be big influences in their lives. But if I get seriously disabled or something, I won't be able to. And that's what scares me the most. If you need long-term care, let's ask these questions and try and answer these yourself, just in your head while you're listening to this. If you need long-term care, where would you like to receive it? Most people say at home or in a nice facility. Most people would like to receive care at their home or at a nice facility. What's going to take money to do those things? Who would you like to provide that care in the event that you need care? Most people say professional caregivers. Very, very, very few people would say, oh, I would love for my children to take care of me. That's going to be a great time when we can all get together and they can be caring for me. Most people say, no, I want a professional caregiver to take care of me so my children can watch it and make sure everything's going okay. How would you pay for it? If you need long-term care, how would you pay for it? Most people have no idea. Most people have absolutely no idea how they would pay for care. At the end of the day, long-term care is not a place or a condition. It's an event that will financially emotionally, and physically devastate, fill in the blank. For me, long-term care, it will financially, emotionally, and physically devastate my wife, Jana, devastate my parents, devastate my in-laws. That's some real stuff when you really begin thinking at and putting it in the consequences of if you need care. What's that really mean? Um, that really means that you're in for a rude awakening if you need care. What's your long-term care plan? Most people say, I don't have one. If you don't have one, in reality, you do. If you don't have a long-term care plan, in reality, you do. Because by not having a plan, you're in essence allocating everything that you have for the event you need it. If you have not allocated some money for long-term care, you're in essence allocating it all. I read this not too long ago, but by doing nothing, by doing absolutely no planning, and that's okay. This webinar is not to tell you you got to do some planning by any means. This webinar is to educate and potentially add some value in the event that's something that you do want to do. But by doing no planning at all, your deductible is everything that you own. Think about it. My health insurance right now that I have, the deductible is like $6,700. Meaning, if I have some serious health stuff going on, I pay $6,700 out of my pocket, and then it's covered. By doing nothing from a long-term care standpoint, my deductible is everything I own. It's my house, it's my car, it's my bank account, my retirement account, my permanent life insurance, literally everything I own. And then my premium is going to be every dime of my income. Because think about it. Your deductible, they're going to make you spend every dime that you have, and we're going to talk about that here later. And then my premium is going to be every bit of my income to pay for whatever care that I need at the time. So if you don't have a plan, in reality, you do. What's your long-term care plan? My spouse will take care of me. That sounds good. It really does. It sounds good. Yeah, my wife's going to take care of me, and my wife does a ton of stuff for me. She picks out my clothes. I can't tell you the last time I cooked anything. I have no idea how to cook. I met her right when I was getting my chef on, right when I was learning how to cook some chicken and some marinate that stuff. And then I met her, and I hadn't cooked in probably 4 years. It's a crazy thing, but do I really want her to care for me that way in the event I need long-term care? No, I don't. What happens if they buckle under the demands of caring for you? Who's going to step in? What's interesting is 45% of the caregiving spouses die before the frail spouse. That's how brutal it is on people. I've never personally had to care for anybody, but I know a lot of stories, and most people have a lot of stories of having to have cared for somebody or seeing somebody being cared for. So 45% of the spouses actually die before the frail spouse. And 55% of the remaining spouses that are still alive, 80% of them are chronically ill. This is not a fun stuff. It's not a fun topic. But if you have the right plans in place, you can totally take that risk off the table. And it's really about getting peace of mind. Peace of mind is worth every dime that you got, in my opinion. What about this idea? Your children will take care of me. Okay. Where do they live, and do they still work? In 20 years, what are they going to be doing? Are they going to be working toward retirement? Maybe getting your grandchildren through college, planning your grandchildren's weddings, maybe having grandchildren of their own. People are living in their 70s, 80s, and 90s, so there's a great chance people have grandchildren and even great-grandchildren. What about their health concerns? Because when you're reaching your 70s or your 80s, if you have children, they're going to be in their late 50s and 60s, which a lot of people have issues at that age. Even if they could put their life on hold and take care of you, do you want them to? I put it just plain and simple. Do you want them to give you a bath and wipe your behind or oversee your care using professional caregivers? Not to be graphic by any means, but it's some serious stuff. Absolutely some serious stuff. I know Richard and Jan Berry, for instance. Richard's mom was 61 years old and when she got terminal cancer. His dad was 19 years older than his mom at the time. So his dad was 80 years old, had glaucoma, and was legally blind when Mr. Berry's mom got cancer. Well, guess what Miss Jan Berry did? She cared for both of them. She literally wiped both of them. And so I've heard their stories. I've seen their passion as they've helped a lot of our clients with long-term care planning. And it's a blessing to be able to transfer that in today and to do the long-term care planning in our office today to help people prevent them having to do that. What about Medicare will pay? A lot of people will say my long-term care plan is Medicare. Well, let's talk about that. As of the Balanced Budget Act of 1997, Medicare will only pay for long-term care when the patient is restoring or rehabilitating. And then it'll only pay for up to 90 days per care benefit period. If the person's receiving care or restoring after 90 days of care, Medicare will allow the insured to draw on 60 lifetime days. That's peanuts in the scheme of things because average claim for a long-term care is 3 years. That's the average stay. 60 days is peanuts compared to 3 years. And so Medicare will only pay if you're restoring or rehabilitating. Well, when you're having a chronic illness and you're becoming frail over time, you're not getting better. You're getting worse. There's a great saying, you're either growing or you're dying. You're either going green or you're going brown. And when you reach that point with a health standpoint, most people don't have a stroke and get better. Honestly, they don't. They stay the same. And once you stop rehabilitating, Medicare will not pay. So Medicare will not pay for long-term care. I'm not going to spend a whole lot of time on this one, but the VA will pay. That's true. VA may receive, veterans may receive long-term care in a VA nursing home. However, the maximum aid and attendance for veterans is $28.37 monthly, and the minimum for a surviving spouse is $11.49 per month. So the VA benefits, they are solid, but you typically got to have some serious disabilities to get a lot of the max pay. That's okay. That's a great, it's a great benefit. I absolutely love veterans. Thank you to all the veterans out there for your service and for allowing me to do what I do. So y'all deserve the world, but the VA regarding caring for long-term care is really not as concrete as a lot of people think. What are some long-term care statistics? 70% of the population will need long-term care. 7 out of 10. You line up 10 people across a wall, 7 out of 10 of those people will need long-term care. That's a big number. In a married couple, there's a 91% chance that at least one spouse will need long-term care. 91% that at least one spouse will need long-term care. I heard a statistic the other day that 80% of women die single. 80% of women die single, meaning they die single because their husband predeceased them if they were married. 80%. That means 80% of the women outlive the husband, which means 80% of men die married, right? So when I say in a married couple, there's a 91% chance that at least one spouse will need long-term care, what's that really mean for the woman? Here's what that means. You're either going to have to watch your husband need care there's a 91% chance that what I'm about to say is going to happen, that you're going to have to watch your husband need care or you're going to be the one needing care. And when you need care, there's an 80% chance that you're going to be single because your husband predeceased you. These are not fun times. The average stay in a nursing home is 3 years. However, over half of the claim today is dementia and Alzheimer's. The average stay for that is 6 to 8 years. That's a long time. Y'all know as well as I do with the medicines, the medical procedures. People are living much, much, much longer. And what's happening is our physical health is staying good, meaning like the medications we're on are keeping the blood pressure, the cholesterol, the body's still going, but a lot of that stuff is messing up the mind, which is why 50% of claims to mention Alzheimer's. Cancer and heart disease are the two biggest killers in America, with Alzheimer's third. However, Alzheimer's is set to pass that by a huge amount because of everything I just mentioned. Because these doctors are doing a great job of keeping the bodies healthy. People are typically eating right nowadays. That's a big deal. They're working out. They're expecting to live longer. But what that's doing is giving more time for the mind to go, which is why so much of the claim today for long-term care is due to dementia or Alzheimer's or short-term memory loss. But what's average really mean? Here's what average really means. In other words, if your hair is on fire and you're standing in a bucket of ice water, on average, your torso should be comfortable. So average is crazy because average means 50% of people are above average, 50% are below. So if your head was on fire, but your feet were ice cold, well, then your torso should feel pretty good. Why is long-term care a thing? Why is long-term care even a thing today? Because of the silver tsunami. There are 10,000 baby boomers per day turning 65 and will continue at this rate until 2030. Think about that for a second. 10,000 baby boomers a day are turning 65. And they're going to be doing that over the next 11 years. The percentage of the U.S. population over age 65. Well, in 1930, it was only 5.4%. So think about it. People were not living near as long back in the day. Around that time was when Social Security was created. When Social Security first started, does anybody know what the earliest age you could turn it on when Social Security was first invented? The age was 65. Does anybody know what the life expectancy was when it was first created? 63. If you made it to 65, to draw on Social Security, how long did you draw on it before you died? 2 years. So if you made it to 65, you died at 67. Well, what is Social Security about today? People turn it on at age 62, and then they live into their upper 80s, right? And here's why. In 1930, only 5% were over 65. In 2000, that was 12%. By 2030, 1 out of 4 people are going to be over 65 years of age, which is why the inflationary cost of healthcare is going at 5.5% according to Bloomberg. Why else is it a big need? The life expectancy is 86.6 years of age for a man, and it's 88.8 for a woman. That's life expectancy. 50% of people are going to meet life expectancy. If you're a married couple, there's a 50% chance that one spouse will live to 92. And listen to this, there's a 25% chance that one spouse will live to 97. Times are different. Times are absolutely different. Let me look at something that one of my buddies sent me the other day. Human lifespan could soon pass 100 years, says Bank of America. Human lifespan could soon pass up to 100 years due to medical technology. 100 years. That's going to be average. In the Time magazine, I read this in the big Time magazine probably 6 months ago, that someone alive today, whether a 10-year-old, a 20-year-old, a 30-year-old, someone alive today will live to be 150. I have no idea if that'll happen or not. I may be the one to live to be 150. I have no idea. The times are changed. That's why long-term care is such a big thing in today. What are the costs of care in the Carolinas? That's all that I'm really concerned about is North Carolina and South Carolina. Those are the two states that Berry Financial is licensed in, is South Carolina and North Carolina. The cost of care for home care is $45,760 currently. That's 5.5 hours a day. So you're looking at 45 grand for home care. That is on average. What's that mean again? 50% costs less, 50% costs more. Assisted living today, on average in the Carolinas, is $54,315. What's nursing home today? Full-fledged, semi-private room nursing home, almost $75,000 in the Carolinas. If you talk to people up in New York, New Jersey, Massachusetts, the places up there, they say it's 100 grand, 100 plus grand already today. Well, with the 5.5% inflation, let's look at some of these numbers. 2025 home care, 63 grand a year. In 2030 home care, 82,000 a year. 2035, 100 grand a year for home care. So think about it. If you're 60 years old, hopefully you don't need care, Lord willing, for 20 years. But in 15 years, they're saying home care is going to be over 100 grand. Assisted living, almost 130 grand. A semi-private room, full-fledged nursing facility is projected to be 180 grand at 5.5% inflation. Will they have to change some things? Something's got to change, no doubt about it. Or if those prices are the same, you better have some planning in force. If these prices end up being legit, which only time will tell, as of August 8, 2019, nobody knows what it will be in the future. But if those are the costs, you better have a type of plan. So there's 3 ways to pay for long-term care. 3 ways and 3 ways only. The first, self-funding. Okay, we'll talk about that. Self-funding. You can definitely self-fund. If you got solid monies, if you think you've got enough monies to self-fund, you can do that. If you think you're not going to need care, well, then once again, your plan is everything you own, and hopefully you won't need care. I hope I don't need care, but statistically speaking, there's a 90% chance that myself or my wife will need some form of care. You can self-fund, though. You can go on to Medicaid. That sounds like a fun idea, doesn't it? We'll talk about the numbers. Or you can buy long-term care insurance. There's 2 types, traditional or a hybrid / asset-based long-term care plan. That's it. These are the 3 ways. There's no other way to pay for care. You're either going to self-fund, which means you're going to spend your money, or if you got a friend or family member that's on the hook, they'll spend their money. You're a self-funder. You go on Medicaid, or you buy long-term care insurance. So should you self-fund? Here's the biggest thing that I want to talk about self-funding is assets don't pay for care. Income pays for care. These facilities and these home care agencies, assisted living, nursing facilities, independent living, they don't care how much money you got. They don't. They want to know, can you afford the $4,000, $5,000, $6,000, $7,000 a month bill? It costs $6,000 a month to get here or to stay here and get this care. They don't care how you get it. They just want to know, can you afford it? So they don't care if you got $2 million sitting in Fidelity brokerage account. They want to know, can you afford this bill? So when we're doing planning, we look at income sources. We look at people's Social Security. We look at people's pensions. We look at people if they're living off dividends. Maybe they're using an income annuity. guaranteed income stream using a form of annuity, right? So assets don't pay for care. Income pays for care. Do you pay for car insurance? Yeah, most people do. I actually think it's a law. You got to pay for car insurance. And I think about it, less than 18% of people ever file a claim. So should you self-fund? Well, if you're going to self-fund for long-term care, why not self-fund for your car insurance, right? Less than an 18% of chance that you'll ever file a claim. You pay for homeowners insurance. Because if you're a true self-funder, if your plan is to self-fund for long-term care, go ahead and roll the dice. In our opinion, don't pay for homeowners insurance because there's less than a 5% chance that you'll file a claim on your homeowners insurance. But if you're planning on self-funding for long-term care, a long-term care event, just know that you personally have a 70% chance of filing a claim. And if you're married, that's 90-some% chance that one of y'all will need it. So the self-fund sounds good. Even if you got $500,000, that sounds good. But seriously, how long is that money gonna last if you got $100,000 bill coming in? So still going on self-funding. Most people have money in pre-tax accounts. The baby boomers are the wealthiest generation in your pre-tax accounts. I'm talking about IRAs, 401ks, 403bs, TSPs, profit sharing plans, KIOs, deferred comps, 457s, right? Most people have their life savings in pre-tax accounts. So when you are a self-funder and your money is in a pre-tax account, you have to pull money out of that. But what does that really do? That increases your taxable income. So now you owe more tax and you're going to receive less money. So if you're bringing in $100,000 from your IRA, what's that do to your tax rate? Boom, jumps it up. What if you got to take out another 50 grand from your IRA or pre-tax account? Jumps it up even more. So really, to net $70,000 bill or assisted living, to net a $70,000, depending on the tax rates, you got to pull out 100 grand just to net that. Well, how long is it going to take your biggest retirement account if you're pulling out 100 grand every year? See, so the self-funding sounds good, but can you really afford another $7,000 to $9,000 bill every month? Warren Buffett and Bill Gates can self-fund, don't you think? They both bought long-term care insurance. See, it's all about risk. We're in the business of risk management and the peace of mind. Because if you did not have car insurance, you'd be scared every time you drove that someone was going to hit you or you were going to hit somebody with your vehicle and be on the hook for a ton of money. If you didn't have your home insurance, every time a hurricane comes, every time it rains hard, or every time the wind blows, you'd be scared that your home, something would happen to your home and you'd be on the hook for a ton of money. Well, chances are if you hadn't done any long-term care planning, you're somewhat concerned about it. So really by taking away the self-fund out of play, you get a lot more peace of mind. How's Medicaid work? Here's how it works. If you are single, they make you spend down all of your assets to $2,000. They literally make you spend down your money first if you need care, everything you own down to $2,000, and then they'll give you a whopping $30 a month worth of income, $30 a month worth of income, and then they make you take the equity out of your home, and they take the equity out of your car before Medicaid will pay. So if we look back at your goals, if your goals are the ways to fund, if you didn't want to self-fund, but then you go on Medicaid, here's what's going to happen. If you're single, they make you spend down everything you own to $2,000. If you're married, they'll let you have $68,000 worth of assets for the community spouse. And then the community spouse will be able to still keep $2,980 a month of income. Well, does $2,980.50 cover your monthly bills? Because if that spouse needs care and goes to a facility, they'll make you spend everything above that 2980 for their care before Medicaid will pick up. Most people still have household bills when one person needs care. So if your bills are more than the 2980, you will be forced to leave your home or forced to do some other planning. They'll let you keep a home equity of less than 500,000, and they will let you keep a vehicle for the community spouse. So see, the Medicaid planning is not a good option. It's a good option if that's all that you have. But if you can place some assets in a different position to possibly prevent that, that might be a better strategy. And you see, what's interesting is a lot of these facilities that take Medicaid patients are actually losing money. So when these facilities care for someone who has drawn down on Medicaid, they are losing money on that individual. So do you think that care is going to be good? I mean, what do y'all think? If they're going to lose money on that, do you think they're going to eventually not offer that to the Medicaid patients? That's why these private pay facilities are getting big. They don't want Medicaid patients. They want someone who can give them the full price of the care, and then those facilities are going to be the better ones. The private pay facilities are going to give you the better care because these Medicaid care facilities are losing money on patients. Medicaid planning, giving your money away. Some people say, I'm going to give it all away before you need that. You can give all your money away or put it in an irrevocable trust. You can definitely do that. However, you have to do that 5 years before you go on Medicaid, or they'll use a look back period and still get the money. What's that mean? If you got $500,000 and you give it all away, you say, hey, I'm getting ill, I'm getting frail, I want my children to get this money, I don't want to waste it on a nursing home, then you give that $500,000 away. If you need care within that first 5 years, depending on how much care you need, if it's within 5 years of you giving away that money, those people will actually, or Medicaid will come back and retake that money from your family. If you need care after 5 years, you're good. But they're actually looking at extending that look back period to 7 years. Maybe it'll go to 9, 10, 15 years in the future. Nobody knows. But what you're in essence doing is you're saying basically, hey, I'm going on Medicaid. And we just discussed that these homes are not going to be as quality care as the other homes, as the private pay facilities. So that was the second option. We went through self-fund, we went through Medicaid planning. Now let's look at the two types of long-term care. There are two types of long-term care insurance. We talked about self-funding, we talked about Medicaid planning, and here's the long-term care insurance. There's two types. There's something that's called traditional long-term care. This is what people bought back in the back when it first came out. There was like 100 carriers that were offering 100 insurance carriers offering traditional long-term care. Now there's less than like 6. Traditional long-term care premiums are not guaranteed. We have literally seen premiums increase 50% all the way to 120%. Meaning if your bill was $3,000 a year, well, now it may be $6,000 a year. Those premiums are not guaranteed. Chances are they will increase because these people price these insurance companies price these traditional care policies extremely wrong. Back in the day, people weren't living as long. That's when they came out with these policies. There's also a limited pool of money on traditional policies, meaning you may have a benefit of 200 grand. Meaning, if you spend more than that $200,000, you're on the hook. Sometimes the pool of money could be 300,000. Sometimes it could be 600,000. With traditional long-term care policies, there's always a limited pool of money. There's no death benefit, meaning if you're paying for a traditional policy, let's say I'm paying $5,000 a year, I'll pay $5,000, I'll pay $5,000, I'll pay $5,000. If I die and never need care, I lost all that money. My family doesn't get anything. It's basically like car insurance or home insurance or term life insurance. You pay, you pay, you pay. If you never use it, you lose it. The good news is you don't need care. The bad news is you lost all that money, which could have been transferred to your family. You typically pay for life. With traditional long-term care insurance, you typically pay for life. You pay every year, and there's no cash value. If you ever need to come back and use some of those resources, or use some of the money that you put in, there's no cash value. It's literally like term life insurance or your car insurance. Let's jump into the hybrid and asset-based long-term care. These policies are getting huge nowadays. We absolutely love them. We absolutely love hybrid and asset-based long-term care plans. Why? If you get the right one, the premiums are guaranteed to never increase. That right there is a peace of mind play. You're not getting locked into something and then hoping and praying that the price doesn't increase. With these plans, the premium is guaranteed to never increase. Some of these hybrid plans have unlimited monthly benefits. Unlimited lifetime monthly benefits. See, when you're buying a long-term care policy, it's all about the monthly benefit. Based on the monthly benefits you want, based on the age that you get it, and based on the health at the time that you get it, that'll all determine the monthly benefit. So what's that really mean? Well, if you got like a $5,000 monthly benefit, if you need care, that policy will pay out $5,000. Well, you can get that $5,000 unlimited as long as you need care. There's a death benefit in case you never use it. We'll look at an example, but somebody's going to get anywhere from 70% to 130% of whatever you put into it. Somebody's going to get a death benefit if you die and never need care, which is a win-win. You can pay it all in one lump sum. You can pay it in 5 years, 10 years, 20 years, or you can pay for life. So it's flexible on the time that you pay. Of course, if you pay it in a lump sum, it's going to be more initially, but it typically is cheaper over time. We'll show some examples. And there is a cash value to use as an asset, meaning it's basically like a bank account. These hybrid and asset-based policies are like a bank account, meaning if you put a ton of money into this thing and then you had to get your hands on some money, you just had to, then you'll be able to get some monies out from your plan. How do you qualify for care? This is very important. So you could be putting a lot of monies into long-term care or really thinking about putting monies into long-term care insurance. And here's the big deal is how do you qualify? 90-something% of long-term care policies have these qualifications, meaning if you have a cognitive disorder such as Alzheimer's, dementia, or short-term memory loss, or if you have the inability to safely perform 2 or more of the ADLs, which are activities of daily living, eating, bathing, dressing, toileting, continence, which has to do with the bowels and kidneys, and transferring, moving room to room, getting up and down off the toilet, going outside to the car. If you have a cognitive disorder or if you have a physical disorder where you can't perform 2 of those by yourself safely, then your policy will pay. Some of those older plans do not have the cognitive disorder, meaning you literally can't do physical activities. It won't pay if you have a cognitive disorder. We don't like that. Why? Over 50% of claim today is the Alzheimer's. We want that covered. We want that benefit covered. There's also usually waiting periods. So a lot of these plans have waiting periods, meaning, okay, do you qualify for care? meaning your doctor says and writes a note, hey, he's having dementia, they're having short-term memory loss, or yes, they definitely are having trouble performing their activities of daily living. Once that happens, there's usually a waiting period. That waiting period can be anywhere from 0 home days, meaning it'll pay immediately for home health care. Maybe it'll pay after 30 days for home health care. The longest we typically see are anywhere from 90-day waiting period to 180 plan or day waiting period. We don't like anything that's longer than 90 days because what that means is, okay, you get the letter from the doctor that says, hey, they're having trouble for care, or they're having trouble, they need care. And then boom, if you have a 90-day waiting period, you've got to pay for the first 90 days of care before your policy kicks in. Well, 3 months at $6,000 to $10,000 a month is some serious change. That's some serious change. Now, it's a lot better than not having anything, but the waiting periods are big deals. So make sure if you got a policy, or if you're looking at a policy, the waiting or elimination period, as some people call them, is very important. Let's look at an example of an asset-based joint policy. There's very, very, very few joint policies today. They give you a huge discount if you are married looking for a joint policy. They give you a huge discount. So how does this look like? Or what does this look like? Let's say you got two 65-year-olds and they want a $5,000 unlimited lifetime monthly benefit per person. How much does it cost? Well, let's think about it. That is 60 grand a year per person, unlimited lifetime if these 65-year-olds need care. If they do a lump sum, it's going to cost them almost $155,000 right up front. That's a lot of money, $155,000 lump sum. But let's think about that. That gets them a 60 grand unlimited lifetime benefit per person. If they die and never need care, they put in 154, their family gets 166 tax-free. Somebody gets every dime that these people put in, and it gets them a 60 grand per person. That means that if they need care and one of them, just one person in this example, needs care for 5 years, 60,000 times 5 is $300,000. All these people put in was 155. That's a pretty good deal. What if they both need care? That's $120,000 per year unlimited. What if they both need care for 8 years? That could easily happen. If you're the person that needs care, or if you're the married couple that happens to need care, that's a lot of money. They paid out $960,000 tax-free, and all these people ever put in was $154,689. See, insurance it's $1 doing the work of many. There is no place on the planet that you can put $155,000 and get a potential 120 grand a year of benefits in the event y'all need care. What if you paid that same premium over 10 years? You would pay $19,755. So over 10 years, the same exact 60 grand benefit would cost you $197. I mean, we're talking some serious money. That's why it's not right for everybody. But we truly believe if you have the money and if you have the health, it's a no-brainer, in our opinion. So would you put in $197,000 with potential to draw 120 grand every year the rest of your life if you both need care? What if you paid it out over 20 years? It reduces the premium to $12,652, but over 20 years you'll have put in $253. So you would have put in $253,000 for a $60,000 a year month or benefit, or $5,000 monthly benefit. So what's that mean though? If you can't perform 2 of your activities of daily living, or if you have a cognitive disorder, and then you meet that waiting period, they start sending out $5,000 a month for your care. That $5,000 a month is tax-free. Long-term care insurance benefits are tax-free. That's a big deal. So we're at the lowest tax rates we've ever seen as a country. If they go up 50%, if they go up literally double what they are now, it'll have no bearing on your long-term care insurance benefits. Those benefits are tax-free. These prices are based on health and age. That is very important. If you ask what's the best age to get it, it's right now. Straight up, it's right now. Because it's never as cheap as it is today. Never, because you're never as young as you are today. You can have a ton of money, but if your health is not right, you can't get the insurance. These companies are getting a lot more lenient on that stuff, meaning if you've had a stroke or cancer or heart attack, or if you're insulin diabetic, depending on, if you have all those issues at the same time, there's a great chance you cannot get the coverage. If you have one of those issues and you had it 2 weeks ago or 6 months from now, or 6 months ago, there's still a chance you may not get coverage. But if you had cancer or heart attack or something crazy like that, but it's been 4 or 5 years, there's still a great chance you could get coverage. But you could have $10 million, but if your health has changed, you're not getting this coverage. So these plans are purely based on health, and they're based on age. Let's talk a little more about the facts. 70% of population and almost predictably 100% of at least one spouse will need long-term care. 2/3 of people who live to be 60 will live into their 90s. So if you've made it to 60, there's a 67% chance you're going to live to your 90s. 45% of the spouses who are the caregivers will die before the person they're caring for, and 80% of the people that are still alive will be chronically ill. In many cases, a married couple will have to liquidate much of their assets so the surviving spouse can maintain their financial independence. This stuff is not some fun stuff. And long-term care insurance is much like life insurance and disability insurance. It's a love gift. You buy long-term care insurance for your family and for your loved ones. You don't buy it for yourself. You buy it for your family and for your loved ones. So let's look at a few considerations. How do you want to receive care? You got to answer that for yourself. I can't make you want to get great care. I can't make you want to protect against the risk if you need care. Where do you want to receive care? Most people say your home or a nice facility. Who do you want to provide the care? Answer these questions whenever y'all get some time, when you're thinking about it. These are questions that you need to answer. How will you pay for care? How do you feel about your current long-term care plan? Remember, if you don't have a plan, everything that you own is subject to the nursing facility and subject to spending down for your care. How would you feel if you invested in an asset-based long-term care plan like we just discussed? 100% of people, 100% of people that have a hybrid or asset-based plan have the peace of mind that they've got a solid plan, knowing that their premiums are guaranteed, and a lot of times their benefits are unlimited. 78% of people have not communicated their long-term care desires with their spouse, partner, children, or other family. And here's why. The absence of discussions may create blind spots. There's a direct correlation between how difficult a subject is to talk about and how important it is to have that talk. Isn't that interesting? I've never heard it put that way. There's a direct correlation between how difficult it is to talk about something and how important it is to have that talk. I am that way. Full disclosure, I'm that way. When it's an important discussion that has to be had, I don't want to have it. I put that thing off as long as I possibly can, because if it's a difficult subject to talk about, I don't want to have it. But guess what? Every difficult decision to talk about typically is important. While you have time and you're not in a panic to think about it, or is the best time to talk about long-term care. That's the best time. Why? Because when someone has a stroke and then they want to talk about care, it's typically not the best time. One, from a health standpoint, it's too late, and two, because everybody's panicky and spur of the moment decisions are difficult. It's human nature to put things off that feel uneasy. It's human nature. I get that. But think about it. Long-term care usually means the frail person's life does not end, but someone else's does. So when you need care, it is what it is. You need care. But don't make the person around you end their life to help care for you. Perhaps the greatest benefit of long-term care insurance is that it can allow loved ones to care about you instead of having to care for you. How powerful is that? Long-term care insurance. So when I asked this a little bit earlier, what does long-term care insurance mean to you? Some people say nursing home. Well, long-term care insurance means to me, it's stay-at-home insurance. Long-term care insurance is get professional care insurance. It's make sure your family doesn't have to care for you insurance. That's what it really is. It's peace of mind insurance. At the end of the day, long-term care insurance is designed to protect your family from that financial, physical, and emotional disaster. Straight up, as someone who talks about money every single day of my life, someone that reads about money and financial decisions every day of my life because it is my passion. God has blessed me with that passion for finance, for financial planning, for giving people peace of mind with their money. Because that very financial, our mission is to give people peace of mind with their money. Our purpose is to love you like Jesus loves you, but our mission is to give you peace of mind with your money. And straight up, purchasing long-term care insurance could potentially be one of the greatest decisions that you ever make. It is not right for everybody, but if you're worried about what'll happen if you need care, whether it's you're worried about having to spend down all your money, whether you're worried about having your spouse care for you, whether you're worried about having your children care for you, your friends care for you, your niece or nephew care for you, whether you're worried about going to a facility that's not nice, if any of those things describe you, please, please, please have the conversation about long-term care. Figure out if you can get approved from a health standpoint. Figure out if the finances make sense. Not everybody can afford it and not everybody can qualify for it. But there's absolutely no cost to trying to get coverage if you think you want it, for the peace of mind that it's going to provide. This is my wife and my golden doodle. My wife's name is Jana. My golden doodle is named Chance. They are my family. I absolutely love them. I love my mom and dad. I love my in-laws. I love Berry Financial. Thank you all for attending tonight. I absolutely love you guys. I hope y'all are having a rocking summer so far. Please reach out with any questions. Respond to the email that was sent for the Zoom webinar. God bless y'all. Thank you so much for attending tonight. I hope you have a great rest of the night.